Thank you, Sydney. Thank you to everyone here, and welcome to the Silicon Valley Crowdfund Conference. It's great to be here. I'm actually based in the Manhattan, New York office, so we're getting about 18 inches of snow right now. So compared to the rain, this is a nice change. Also here, I don't know how many of you go grocery shopping on the East Coast, but the fruit is extremely fresh and available, and something I'm not used to where we can go here. So, in any event, I grew up actually in Southern California, in Los Angeles, Encino, and San Fernando Valley, and made my way east and have been practicing law for 25 years. I've been in New York for the last 20 years. Worked in-house at various investment banks, Citigroup and Barclays, as well as at two major law firms in New York, Weil, Gotshal, and Paul Weiss, and developed my practice now around early-stage capital raising expertise in how to raise money online. What can we sell? Where can we sell it? And from whom? And with what materials? Do we need a license for Canada? How can I get in a Hong Kong investor? What about if I want to sell an Australian deal in the U.S.? All of these are questions that we deal with every day, and all of them have answers of some sort or another. I'm going to talk a little bit today for the next 15 minutes or so about what I see the Trump administration and the new administration and its impact on crowdfunding and online lending or marketplace lending, which is a close relative of crowdfunding. It's a form of debt crowdfunding in some forms. And we'll talk a little bit about both. And now that my flight's been canceled, I'm going to be here for most of the day. So happy to take any questions now or afterwards. So let's get started. So we have the election. Everyone knows what happened. And I'm not going to be overtly political or disparaging to either president, but a couple of surprises, and you know, as we know from the campaigns, neither candidate really focused on crowdfunding or online lending or investing. It was really a campaign that glossed over a lot of the substantive points around FinTech and around online investing. Hillary Clinton actually had a section of her platform page that discussed encouraging innovation and job creation, but that was really as close as we got. Small business job creation is usually a buzzword in our industry for easing capital rules, and so now with President Trump, we haven't really seen exactly what he has in mind, or if he has anything in mind, other than that he's in favor of repealing Dodd-Frank or parts of Dodd-Frank, and has signed last week 2 measures to repeal some of the more important parts of Dodd-Frank. One was the fiduciary duty rule, which was the rule that allowed or that required investment advisors to act with a fiduciary duty towards clients. And so instead of making recommendations based on a suitability analysis that you'd see in a brokerage context, is this investment suitable for you? The rule changed under Dodd-Frank to is this investment actually in your best interests? And it required a deeper dive and deeper analysis, and obviously more money on due diligence and other factors. And a lot of people didn't have a problem with that because it kind of made sense that you should have your client's best interests in mind. But there was a lot of money that had to be invested in these technologies, and that's now been partially stripped away. So we're going to go back a little bit and just talk about the Jobs Act. Sydney mentioned the Jumpstart Business Startups Act. If I can get the slide to go. Here is President Obama in April of 2012 signing the bill, probably the most important bill related to crowdfunding or capital raising in his administration. Over 400 votes in the House, 97 votes in the Senate, one of the most bipartisan measures of any substance that passed through the Congress. And really what it was a complete overhaul of the capital raising rules in a way that made things a little bit more efficient and a little bit more up to date in the 21st century. You'll see behind him former Majority Leader Eric Cantor, and then behind him is Steve Case from AOL, who was a big proponent and still is a big proponent of capital raising. On the far right, in the glasses looking down, is Congressman Patrick McHenry. He is still in the House and is a very strong proponent of crowdfunding and is constantly looking for ways to improve the Jobs Act in ways that that it's not currently serving people, and we'll talk a little bit about what I mean by that. So the Jobs Act overview, to increase American job creation and economic growth, there we go, by improving access to public capital markets for emerging growth companies. There are 4 principal tiers of the Jobs Act. Title I was the IPO on-ramp, the creation of this concept of an emerging growth company, which is any company that had less than $1 billion of revenue over its last balance sheet closing. And if you are an emerging growth company, you can file confidentially with the SEC for an IPO. You can have meetings with investors before you file, called Test the Waters meetings. You are exempt from the Sarbanes-Oxley attribution rules and the where the auditors have to agree with your assessment of internal controls over accounting procedures. And really makes the IPO process more compact. The financial disclosures are reduced from 3 years to 2 years, and your selected financials, which used to be 5 years, are now down to as many years as you show in the audited, which is usually 2 years. So, you know, we have a tool, and the best thing about the IPO on-ramp is that it was enacted immediately upon passage, so it didn't require any further agency rulemaking. So what we see now when we hear, for example, that big companies are going public, if they are emerging growth companies, you're usually hearing that on the 21st day before the roadshow starts, and that's when pricing information is added to the book, and the company is officially announcing that it's going to launch the IPO. It probably has had 2 or 3 review cycles with the SEC before that, and so right now we have this sort of speculative calendar that doesn't firm up until 21 days before, which is universally when everyone announces. Title II, private placement reforms. So private placements used to be private confidential offerings. Now they are able to be made more publicly. You can advertise and solicit for the first time, which I guess obviously goes against what we think of as a private placement. But the old paradox of how do I find somebody who I don't know is somewhat relieved under Title II, because you can now opt for 2 options within the private placement exemption. One, you can advertise, and then the catch is you can only sell to accredited investors, and you have to take reasonably steps to verify that they're accredited. Under the second rule, 506B, which is the old rule, you don't have to advertise, and you don't need to therefore verify that somebody is accredited. There's advantages to advertising and not advertising. The SEC is defined in the 21st century that having a website no longer means you're advertising. It used to be any online presence, any presence at a conference like this, anything you do that mentions the deal is advertising. That's effectively the old IPO quiet period rule. What it's been refined to is if you either have a website which has live deals where you don't need a password sign-in, if you send blast emails to groups of people that have not signed up for updates, or if you use social media to promote live transactions. And it has to be a live deal because the sale is not the business, it's the offering within the business. So if I'm running a crowdfunding campaign and I have 5 transactions up on the screen, if I send out advertisements or I put out promotional material saying earn X amount of dollars, earn X% returns in the crowdfunding industry, that's not advertising. You're advertising your deal, but you're not soliciting an offer because there's nothing for the investor to accept on that transaction. If I say, check out our new crowdfund offering at 123 Main Street, here's the loan to value, here's the projected return, here's the hold, then you're actually engaged in a solicitation process. And so a lot of platforms have switched from the solicitation, which they assumed they were going to need, to the non-solicited world because it makes things easier from a verification perspective. Reg CF, which is the National Crowdfunding Exemption, was Title III of the Jobs Act. We're going to talk a lot more about Reg CF, but it is a national exemption from registration with the SEC. You can raise up to $1 million from both accredited and non-accredited investors. An accredited investor is an individual with $200,000 of income in each of the last 2 years with the expectation of the same level of income in the current year. Or it could be a married couple with $300,000 combined, or a $1 million net worth excluding the value of your primary residence. And there are all sorts of questions around whether the accredited investor test, which has remained the same since 1993, I believe, is going to be increased. The SEC estimates that 92% of Americans live in non-accredited households, so there's a lot of people on the sideline who are not part of the accredited investor world. I think people forget that when they're in the New York, San Francisco mindset that, you know, there's a whole country out there of people who make a decent living, who have great savings and want to invest in projects and want to put money to work. And by and large, the crowdfunding world, other than what we're going to talk about next, is somewhat closed to people who are not accredited. The fourth thing that I'd mention under the Jobs Act is Regulation A+. Many of you have heard of this. This is the exemption that allows you to raise from both accredited and non-accredited investors, the general public, up to $50 million in any rolling 12-month period. Now, what that has done is really opened up the avenue where you could have an unregistered transaction. Registered, I mean, go through an SEC registration similar to an IPO, clear comments, become a public reporting company. You don't have to do that under Regulation A. You can use Regulation A, and there are two tiers to Reg A, which we'll talk about, I think, in our second or third panel. I can't remember which. But what it does with Reg A is you have companies that need not have any real operating history, need not have any substantial operating business plan. They can be funds, they can be new investment vehicles that are created by a sponsor, and you can go out and raise up to $50 million. And we'll talk about the uses that people have thought of with using Reg A, but it's an extremely powerful tool and really opens up another avenue into capital raising that we hadn't seen until Reg A went into effect. There was a Reg A before, which allowed you to raise up to $5 million. But the problem with the earlier version of Reg A is that it didn't have state law preemption, which meant that you had to go from state to state and go through a merit review process before you could start offering securities, which was a somewhat of a drawn-out process because every state would have comments and questions for you. What we have now is a fully preempted, meaning the SEC, through the authority given to it by Congress under the Jobs Act, has put out a Tier 2 Reg A, which many people are using, and you can bypass the state merit review process and do a fully national campaign. Also, what's interesting is Reg A is one of the only laws that I'm aware of in the securities world that is a full U.S. and Canadian cross-border exemption. So a Canadian company can file under Reg A and list securities in all provinces of Canada, as well as 50 states, plus D.C., plus Puerto Rico and the territories. Same thing here. Your qualification under Reg A, if you check off the Canadian box, will include all the provinces in Canada. If any of you have tried to do a transaction in Canada, you know that they have a provincial system of securities regulation where you have to apply to the various provinces where you want to make your offering, and many times the different provinces will have different comment letters for you. If you want to offer in Quebec, then all of your offering materials have to be translated into French, and it can be quite expensive. So those are sort of the four main provisions of the Jobs Act, which we're going to talk about really today and throughout the day. Interesting sort of transformative legislation, not perfect, but certainly something that brought us to a point that we hadn't been before. I should say that outside of the Jobs Act, many states have enacted crowdfunding laws because under the securities law and really under the U.S. Constitution, Congress has only the power to regulate interstate commerce. And so if a transaction takes place solely within the confines of a single state, then Congress really has no way of regulating that, and that falls down to the states. There have been interpretations within what constitutes an offering only being made within the state, and there were issues recently where if you had a server or computer service where the offering was being zapped to investors, but it went through an out-of-state server, does that count as the offering crossing state lines? And many people thought it did. The SEC came back with interpretive guidance recently that said, if you take reasonable steps to prohibit an out-of-state investor from participating in the transaction, then that's good enough. Your computer doesn't have to have a code where when you cross the state line, you're automatically disqualified or you can't even see the deal, which would be very technically difficult to do. This came up in Michigan, actually. They have their own state crowdfunding law, and a company near the border of Indiana was using processing services in Indiana, and Scott's going to probably talk about this in his remarks. And so the SEC settled that and said, if you have investors, every investor must have an address within the state, that you must have bona fide belief that they're in the state. But let's not go crazy and try and figure out where light beams are traveling and whether fiber optic cables are crossing state lines. More of a big deal in areas outside on the East Coast where crossing state lines is pretty frequent. So capital raising post-election, stock market actually has responded very favorably to the Trump victory, the removal of the uncertainty over who's going to win. We had the Dow Jones recently crossed 20,000 for the first time ever. NASDAQ has also set records. I think capital raising in FinTech appears to be somewhat uncorrelated to presidential issues. And I think that we are going to see the crowdfund companies and the lending companies start to consolidate this year. This is going to be a year where you can no longer be experimenting if you're going to be profitable. You have to start scaling up. You have to attract large amounts of capital, and you have to have enough regular traffic and enough regular deals on your site where you really become the one-stop shop. Investors are starting to grow weary, especially in some crowdfunding industries where you're a member of 5 or 6 or 7 different websites because you never know where the good deal is going to pop up. What that means is you have capital not only in your bank account and in your securities investment account, which you can use for your regular way market trading, but you have an alternative account and spread out over multiple websites where you have cash effectively sitting that's ready to be deployed into different investments. And that's something that the what we call the back office industry of Wall Street really hasn't caught up with. None of your regular way brokerage accounts really accept most alternative assets these days. I know OTC is making a big push to allow this, but in the first Reg A transaction that was launched, it was a major issue as to whether the clearing firms and the brokerage firms were going to be able to accept a Reg A security, given that many of them didn't have QSIPs, they didn't have unique identifiers, and so that's something that I think will need further development. We can go. So Regulation A+, a little bit about that. We've seen sort of a few ways of how Regulation A+ is helping. The first is the original intent of Regulation A+, which is to raise money, the mini IPO, common stock off your balance sheet that can be either listed on OTC or you can flip into a listing on one of the exchanges. If you flip into a listing on the exchange, you do file and become a public company with the SEC and have to start doing quarterly reports and 8Ks and 10Ks and 10Qs. If you stay in Reg A land, then there is a separate regime of reports. You have to do a much shortened annual report called the 1K, a semi-annual report called the 1SA, and a current report, which is similar to an 8K, but with many fewer qualifications. So one thing that's important to remember, if you're in the Reg A process, you can do a semi-annual accounting closing as opposed to quarterly, which is the rule for public companies. The other things we've seen with Reg A is some platforms have started to list debt securities. And the debt securities are recourse notes, so they're the obligations of the platform. And what they're doing is they're using the crowd to basically be their bank. And we call this a bankless working capital line, where you can flex the terms of the notes you're offering to whatever the market demand is at the time. And so a company called Street Shares has done this, where they've posted debt securities at they range from 5 to 10% on their site. They've started at 5%, and if the need arises to raise more money, they can open up the lines and move it to a higher coupon if that's what the market demands. But otherwise, what you have here is a situation where you can raise $50 million on a 12-month rolling basis, no bank approval, no bank fees, no unused line fees, and what you would do is structure these where you have no affirmative or negative covenants and they're prepayable at any time. So it's effectively a open ticket, one-way offering that you can do to raise capital when you need it. And let's keep going. So, and I'm going to highlight briefly because I'm going to let Scott take over. But what was new in 2016? Reg CF versus Reg A. Reg CF, the Title III, the national crowdfund exemption, you can only raise $1 million. You have to use a funding portal or a broker-dealer. And there are various other requirements. You have to have an offering circular that's filed with the SEC. You are taking what we call IPO prospectus-style liability on statements in the offering documents, so it is not the same as the Title II or Reg D defense, which is where somebody has to allege intent to defraud. Under Reg CF, there's a strict liability standard, and you know, Reg CF has been I think a qualified success. It competes with Reg A. It competes with the state rules. Some states like Arizona allow $2.5 million. I think other states allow up to $5 million if you're offering it intrastate. The problem with the state rules is, and it's really mandated from the SEC rules, is that the company has to be incorporated in that state. It has to use at least 80% of its proceeds to fund operations in that state. So it's very hard for an out-of-state company to do an intrastate offering if they don't have reason to use the proceeds there. I think, what else do we see? So closed-end funds. So there are a number of funds that have been raised and approved by the SEC to specifically invest in crowdfund and online lending activities, and some of these are going to be significant as we go forward. And then Regulation A, we talked about the equity and bankless working capital lines. REITs are also a very big trend that we're spotting. Many real estate investment trusts are being formed by larger real estate companies or by other companies as a way of raising equity. The advantage of a REIT is that it is, if you meet the REIT qualification test of income and distribution, it is tax-free at an entity level. The other advantage of a REIT is that if it's properly done, it's exempt from the Investment Company Act, so you don't have to be an investment company even if you have more than 100 shareholders, which would ordinarily throw you into investment company registration because of something called the 3C1 rule. Known and unknown changes. So we have a new SEC. We have 3 commissioners that have turned over. Mary Jo White, the chair, has left. Jay Clayton has been appointed by the president, subject to Senate confirmation, to be the chair. We have 2 more vacancies that need to be filled. One will be a Democrat, one will be a Republican. The SEC is bipartisan by rule, and so that's the GOP will then have a 3-2 majority. We have a new appointee to the U.S. Supreme Court. There may be others during the term. It's not clear if there'll be any retirements or, God forbid, any deaths. We have 3 or 4 justices over the age of 80. CFPB, the Consumer Financial Protection Bureau, which was created by Dodd-Frank, many people expect that to be significantly reduced or even done away with because of 2 reasons. One, Trump and others advising him are openly hostile to the CFPB as it relates to being too rigorous on enforcement of consumer protection rules. The second is something called the PHH case, which is a mortgage enforcement case that was appealed to the D.C. Circuit last fall. In October, there was a ruling that said, notwithstanding the issues in this case, the court believes that the CFPB itself is unconstitutional because it has a director who essentially has full power to override administrative law judges within his agency. There's no democratic body of the agency. It's effectively only run by a single director making all the decisions. And there's constitutional issues around having somebody with that much power and authority. And also the director cannot be removed by the president except for cause. Director Cordray's term, Richard Cordray, is up in 2018. And so we'll see if there's a move to change the rules within Dodd-Frank, the Consumer Financial Protection Act, which is part of Dodd-Frank, to allow the president to remove the director or to do something. But they have the tailwind of the court decision that actually rules that the structure of the CFPB today is unconstitutional. I think there's a new SEC small business advocate, which is reporting to the SEC chair. As we've seen before, Democrats are not going anywhere, so Elizabeth Warren been very active, and she will still be active, as we saw with the Wells Fargo hearings, most recently with her with her speeches on the floor with respect to the Attorney General appointments, and OCC charters. So the Office of Comptroller of the Currency has proposed special purpose bank charters be issued to FinTech firms, even if they don't actually qualify as banks, and they need not take deposits. The capital rules around these companies will be are still open to question, but they will be fully preemptive banking entities that will be able to make loans across all 50 states despite not being traditional banks. And there's been a lot of questions and controversy around this proposal. Is it appropriate to single out an industry and call it the FinTech? And at the same time, what's the, what are the actual rules going to be around why favor FinTech over retail? Why couldn't Costco form a bank? And what are we saying about lending? Is that going to disintermediate state lending reviews, which are very rigorous in many cases, including here in California? And the impact on that is still to be seen, but it'll be interesting. The Commissioner of the Currency, Controller of the Currency's term is up in April. He must leave regardless of whether a successor is appointed, and so there's a rush now to see if he's going to push this through or if he's going to leave that for the next person. And then, Dodd-Frank rollback, we mentioned, has started. We're going to probably see more action around this. I think the less controversial aspects of Dodd-Frank will stay. I think swap dealer registration is something that people have gotten comfortable with, and transparency rules. The bad actor rule under Reg D, I doubt that's going to go away. I don't think there's a group out there that's campaigning against the bad actor rule. So, I think we'll see reforms in sort of the too big to fail, the bank charter, and living will provisions and other things. And then quickly, other challenges and unknowns. I think there'll be something called the Madden fix. There's a case called Madden versus Midland Funding, where a loan was sold from a bank to a collection firm, and the court in New York ruled that the collection firm could not charge the same interest that the bank charged. And that threw the securitization and many other industries into a tizzy, which rely on buying banks from loans from banks. There's a rule proposed by McHenry which will fix that. The Fixed Crowdfunding Act, which started last session, I think will be revived. That was a rule to reform Reg CF and make it more issuer friendly, allow companies to raise more capital with less restrictions, perhaps also raising the cap or the threshold under which you'd need an audit done. And then there's a rule proposed last session, which I think will be renewed, the IRS transcript rule. If somebody signs up on your site and they declare that they had X amount of income, there will be a rule that requires a verification be done with the IRS instantaneously, as opposed to the current process, which is to fax in a 4506T transcript request, which takes anywhere from 5 to 25 days, depending on who gets it and how quickly they get done. And then other predictions. I think bad actors will still be dealt with harshly, but if you are taking reasoned views and reasoned positions around a lot of these issues, there's still a lot of room to operate and room to maneuver. And then the biggest issue we also see is this sort of regulation by class action. So even though you're doing everything right, there could be cases brought against you to enforce certain rules or certain actions, or somebody might take a position that you can't make an offering in a certain state without being a licensed broker-dealer, or that you can't do certain things, such as mandatory arbitration clauses. I think the tribe cases, the Indian tribe, I think those are subject to being dealt with more harshly as we go forward as well. There was a major victory by the CFPB against a company called Cash Call, which was using the law of the Cheyenne River Sioux tribe in Idaho, despite all of its operations being done in San Francisco, and the CFPB won a cease and desist order and major fines for them. So I think that's kind of an overview of the regulatory landscape. We're going to talk a little bit more about how crowdfunding works in practice and how the rules interplay with what choice of business platform you use. Like I say to all of my clients or anyone who asks me, it's really a one-size-fits-one universe. There is no universal answer, and I wish all of you good luck as you move down this journey.